Good evening, guys. I wanted to take a few minutes and go through the Excel assignment we had on the operating asset purchase. I recognize that this may seem like a little too late for you, and I apologize I wasn't able to get this completed before that assignment was due, but I wanted to give it to you now. It may be very helpful as you're preparing some of the outlines and then the material for your end of semester project. And moreover, it'll just give you a better sense of my thinking as I was constructing that. So I'm going to go ahead and share my screen. I've got the Excel file open, and I'm going to start to walk through it for you and go through the first couple of lines of forecasting and then look at the valuation, etc. So bear with me a moment. So what we're looking at now is the Erosion Enterprises spreadsheet for the operating asset purchase. And so you'll recognize what we have going on here, but I want to make sure that you understand where different values are coming from, how they're calculated, and their relevance in this. So to begin with, I believe you recognize that we're not going to do a full firm level valuation on Erosion. We've already done some of that. We're simply going to consider the merits of an investment that they might make. In this case, it's an operating asset purchase of a conference and an event space in the United States. And you'll recall that Erosion has their primary income source perhaps in Europe. With some revenues coming out of the U.S. as well. But they're going to expand their marketplace in the U.S., and they're doing this in part through buying a conference and an event space. And this isn't a huge conference and event space. I believe we're going to suggest they're spending $5 million on it, so it's a relatively small one. But let's look at some of the values that we're starting with, and then let's look at some of the assumptions, and then let's see how those play out in terms of the forecasts. So here, as you already have, we've got a long run growth rate of 2.5%. That's come from the financial statement. We got the tax rate, also came from the financial statement. We've got the weighted average cost of capital for the firm as a whole, also from the financial statement, ROIC from the financial statement, and then debt. Well, these are some things that are being calculated, and you say, well, wait a minute, I didn't see debt that looks like 37.5 on the financial statement, and you didn't. This debt amount is calculated from a couple of the new given amounts. Specifically, we're going to invest, I'm going to call it 50 here, but this is 50 times $100,000. The scale here is in thousands. Actually, that should say hundreds of thousands. Excuse me. The scale is in hundreds of thousands. So 100,000 is 5 million. We're going to acquire this using some debt at a 75% loan to value ratio. So this debt is the investment amount times the loan to value. So that gives us the amount of the loan, which is the debt. We're going to acquire that debt at a rate of 6%. So we have a $50 or $5 million asset, 35 of which is depreciable asset. Well, what's the difference here? So we're going to consider that this is land and a building, and we don't get to depreciate land. And so we're making an assumption here, and this assumption would be made based upon information given at the point of sale, that some portion of this $5 million is buying the ground, some portion of the $5 million is buying the building on the ground, and maybe even the things inside of the building. So there's a 35 depreciable asset that's going to have a useful life of 15 years. We're going to make the assumption that we have to continue to make year in and year out a 5% commitment to net capital spending and a 10% commitment to increased working capital. Well, let's see how those come into play. First, the 5%, we're going to make the assumption that it has a 7-year useful life every time we buy more of them. So where does this 5% come into play? Well, remember that I can go to the formulas tab, I can go to trace dependence, and I see that I've got 5% project net capital spending for each of the years of my forecast. Let me get rid of those arrows, are a little bit distracting. Let's go over here and see 5% of what, and what I have is 5% of the revenue. So I'm making an assumption that each year I have a net capital spending of an additional 5% of my revenue. Well, why would I do that? Because I'm depreciating the asset. And if I don't continue to renew, refresh, revitalize the asset, it's going to become stale, it's going to become less productive, and revenues are going to go down. So I have to make that commitment to net capital spending. I'm similarly making a commitment to net working capital. And where am I seeing that? Well, I can look at trace dependence, and I see that in the project net working capital. What is it 10% of? It once again is 10% of project revenue. Remember, we've argued all along that revenues follow assets for about 93% of the firms in the marketplace. So a firm acquires an asset from which it then creates money, revenue, has expenses, operating income, taxable income, net income perhaps. So these are going to increase all of my categories. Let's see what happens to this investment here where we increase our category. Let's see what happens. So I'm putting a project fixed asset at time 1. This is year 1, so the first year that this is in place. So I'm suggesting that even in that first year, we're going to be spending $5,050,000 on additional fixed assets. That's the conference center and event space itself. But even in that year, we're going to have some net capital spending to keep that vibrant and vital. Maybe that's furniture. Maybe it's sound equipment. Maybe it's a lot of things. It could be new windows. It could be signage. It could be all kinds of things, new carpeting, paint, whatever it happens to be. An event space that is used heavily is going to need refreshing rather often. Okay, so those are a few of the initial assumptions we have to think about. Then we've got assumptions with respect to revenue and debt. Well, again, we have debt here because we're going to borrow money to do this. So if we're borrowing 75% of the 5 million or 37.5, that would suggest then that the remainder is going to have to come out of cash somewhere. So we may have to account for that at some point. In our projections and assumptions, we're going to have projections and assumptions for revenues coming from the project, for some erosion of revenues from our existing operation. So we have to make the assumption that if our executives are going to spend time putting this project in play, they probably are going to be distracted. And that distraction, we believe, is going to cost us 1% of our revenues out of the European Union, which is not trivial. So we're going to account for it. We're further going to assume that in the first period, our revenues are going to start at 300,000, and our expenses without depreciation and amortization will start at 3.5 or 350,000. So we'll have to think about what that depreciation, where that's coming from, how that's reflected here in a few moments. In fact, we'll see it here pretty quickly. We're going to make the assumption that every year we're paying down the debt by 0.25 or $25,000 in this case. We're going to assume that in the first year after we put this into place, so the second year after acquisition, that the revenue grows at 40%, the next year at 30, the next year at 25, the next year at 20, and then finally it normalizes out to about 2.5%. Well, these might seem like great big numbers, 40% revenue growth in a year. Well, for a whole company, that might be significant, especially if it's a mature company like Erosion. But for a new part of the company, maybe that's not significant. In fact, we believe it's going to start with 300,000 in revenues, and that's going to grow by 40% in the first year as the market begins to realize we're there, as we're doing marketing, as our clients are starting to use the space, et cetera. So these aren't outsized. And we're going to make the assumption that that 1% EU erosion takes place during the first year and the second year, but thereafter doesn't take place any longer. We've made our adjustments. Our management's no longer distracted. Maybe we've hired the right people. Things are up and going. We're further going to suppose that our operating expense without depreciation and amortization will be 65% of our revenue. Well, that's not unusual, of course. In the first full year of operation, we have the operating expense here of 3.5 in the first year, And then we believe it's going to be 65% of revenue thereafter. Well, as I look at this, I can't see that in a forecast ratio. A valid forecast ratio typically would be the operating expense category divided by the revenue. Well, 3.5 divided by 3 is not 0.65. That gets 1 point something. But that's the first year of operation where expenses are high, productivity is low, revenues are minimal, et cetera. In fact, we see this starting in the second year, that falls from the 3.5 or 100% plus level down to 65% of revenue, to 60%, 55, and this stays constant at 55 thereafter. So we're supposing here that some of our expenses are productive for us, but as we reach some kind of scale economy with this new operation, they're growing. And we believe that each year we're going to have a $25,000 pay down in our debt. So let's go ahead and start to look at our years here. Notice, first of all, I have virtually nothing for year 0 because this is unlike the existing company where we had a year 0 that we could measure. Year 0, this was an idea. We hadn't spent any money on it. Nothing was happening with it. So it's literally nothing all across the board. Now, you might argue here that in year 0, we took on some debt. We went ahead and found the facility. We spent some money, and that's all going to be embodied in our project free cash flow and in our net present value, profit index, present value, et cetera, calculations down here when we look at the valuation structure. And you can already see that I'm going to use a free cash flow model as I look at the valuation structure. You might ask why we're using free cash flow instead of a multiple. And the fact of the matter is, while we might have some aspirational multiple for a project, we might have some observable multiple on projects within our company, or maybe we know somebody that's done something like this in the past, it's not likely that we can find a multiple for this kind of a project with this kind of specificity in deal stats or pitch book. So it becomes kind of a stretch to apply a valuation multiple to it. So we go strictly to a discounted cash flow on this. Now, this is a real estate project. And so you might now, with a little bit of real estate understanding that we've been generating, you might wonder if we can even think about this with a capitalization rate. And it may come as no surprise to you that we might actually do that as we finish up the real estate component of our course this semester. But let's go up here. So I'm going to put together now debt, project revenue, project erosion, project Opex, depreciation, expense erosion, and EBIT. I'm going to stop at that point and kind of regroup for a moment. So where did I find debt? Well, I got debt from the first period's debt. So we're making this investment and we have the debt hit us in the first period, including the debt pay down. So this would suggest, excuse me, that we're acquiring the debt at the very beginning of that first period. And we then, by the end of that period, are paying off $25,000 of that debt. The project revenue is coming from our assumption. The erosion is coming from 1% of the valuation without adjustments. Well, let's go there real quick. Valuation without adjustments. And 1% of that, let's go back real quick to see what cell that was in. That was in cell C12 of that worksheet. So valuation without adjustments, let's go look at C12. Here is C12. and our European operation, which we're measuring here in dollars, of course, US dollars instead of euro, but we see the revenue. And remember that Marriage Ravana was primarily a Eastern European consulting company. So we think we're going to have some erosion as our managers help put this into play. Well, so the total project revenue will be the revenue that we project for the project minus the expense erosion. So we're going to have to assign to this project and have it make up for that expense erosion, which is a function of putting it into place. So what's the project Opex without depreciation? Well, it's exactly what we said here in our assumptions panel. Where do we get the depreciation? Well, I can look here and I can see that I have, for this first period of time, I've got W20, which is my gross depreciable fixed asset, divided by the useful life of that. Now, this metric might change here in a moment, and I just want us to get to be comfortable with that. There's a couple of ways of doing this, and I'm showing both of them to you. So I can either take my depreciable asset divided by the number of years, and that should then give me the depreciation for that period of time, or I can look at the utility of a depreciation, a fixed asset purchase and depreciation schedule. So we're going to look at that as we then come back in a moment to do the second period. So the next line is I've got an expense erosion. Well, expense erosion, what's that? Well, I took a look at all of the expenses that I had in year one for Marriage Ravana, and recognizing that I've got some revenue erosion, the expenses that typically would go along with that revenue are no longer present because the revenue is not present. We don't have the cost of goods sold. We don't have the personnel. We don't have those other items. So we've got those, and that's from D19 to G19 in the value without adjustments worksheet. Let's see what those columns look like. So D19, excuse me, I want to make sure I'm looking at the right item here. Did that say 19? And D19 to G19 in value without adjustments. So let's see what we've got on adjustments down here in 19. So what I've got is I've got percentages. So I have some percentage that I'm building up of my forecast ratios, and I've summed them. What am I doing with that sum? So I'm going to go back over here, my expense erosion, and I'm now going to take the revenue erosion times the forecast ratio that goes along with that revenue. Well, that's the only realistic way I could do that because I don't know what the actual expenses were from looking at the value without adjustments. I don't know what the expenses were for that revenue, but I know what the expenses are on any given dollar of revenue. And I can know that through the forecast ratio. Okay, so that makes sense to me. And now I've gone ahead and applied them here by taking the revenue erosion times the sum of those forecast ratios, and that gives me my expense erosion. And then I can take the sum of all of those from project revenue minus Opex of the project, minus without depreciation, then subtract depreciation, and then notice that I'm adding the revenue erosion. Well, revenue erosion was a deduction when I looked at total revenue, but now I'm adding it because removal of an expense is an improvement on EBIT, not a reduction of EBIT. Think about that for a minute. To deal with my revenue erosion, I deducted that before getting to total revenue. To think of my expense erosion, I'm going to increase my EBIT for the project by that expense that I now know I will not bear because of the project. And that then results in an EBIT of 3.563 in the negative. Well, that's just not good. So let's see what we've got as we continue on. For the first time now, we're going to critically think about interest expense. You're probably now going to say, wait, we're thinking about interest expense in our real estate example that we're starting to work on with Weston Lackey as well. And that's correct. But in this case, we are looking at a firm level project, which is a very different thing than looking at buying a firm as an asset, where it doesn't make any difference who the owner is. We need to have valuation metrics that are agnostic of that ownership, the equity stakeholders. Well, here, it's a firm level project. We can't avoid who the owners are. They are the firm. And the managers have decided to go ahead and capitalize this a little bit with cash and a lot with some debt. So $3.5 million of debt. So that means $1.5 million in cash. Well, our interest expense on that debt for the year is going to be the debt amount for the year times 6% interest. So that's our interest expense. We then go ahead and subtract that from EBIT to get our taxable income. We have a negative value here. And because of that, there's no income tax on it. So net income is going to be the taxable income, which is negative, minus 0. So we, again, have a negative net income. Well, that all makes sense. I don't love it, of course. In fact, frankly, my concern is that we've got a negative EBIT coming all the way through this. We've got negative net income coming all through this. Because we have negative net income and taxable income, and I said negative EBIT a second ago, please excuse me, I meant negative taxable income. Now I have negative income tax or zero income tax. So I've got this kind of ugly picture developing in front of me with respect to running this event space for which we just spent $5 million. I'm a little concerned about that. Okay, so as we now go past the income statement and deal with the balance sheet, where am I getting my numbers from? I've got invested capital. Invested capital is going to be my project fixed assets. Remember, my project fixed assets came from the original $5 million and then some additional net capital spending. My invested capital is going to then include project net working capital. Well, what's the project net working capital? It is the revenue for the project times the percentage rate of the net working capital commitment in my assumptions. So that gives me the project net working capital. If I take that invested capital for the project, I add them together. Well, that's good. That makes sense. And I think I'm okay here. I'm looking at net operating profit after tax now. So that's going to be net operating profit or EBIT after tax. Well, tax is 0. So my EBIT is the same negative as my NOPAT. I've looked at project net working capital and where that came from. I've looked at project net capital spending, where that came from. Gross depreciable asset, where that has come from. And now project gross fixed asset. So now what I'm left with is project free cash flow. So how am I calculating it? Well, this might be a little challenging to get your head around, but let's see what we can do together. Remember, free cash flow is the net operating profit after tax or adjusted for tax for a period, plus depreciation and amortization for that period, minus change in net working capital. So that period's net working capital minus the period before for the project in this case. Then minus net capital spending, which would be the project's fixed asset for that period, minus the fixed asset for the project the period before. Remember, the period before, period 0, there was no fixed asset because there was no project. There was no working capital, no net capital spending. So we're comparing this against a period of time where there was nothing. And that's our period from which we're changing. So 0 changing to something. So we're going to have a big, excuse me, big change here. And that then is going to result in our project free cash flow. So let's see what we've got. Well, here we have NOPAT plus depreciation minus S20 minus T19. Well, S and T are right here. This is S20 minus T19. This is my change in net working capital. So I have 0.3 net working capital having changed from 0. And then I have net capital spending of 0.15. Well, let's figure out how I got that. So remember, I got that net capital spending from a dollar amount of revenue and 5% improvement on that as we grew our net capital, our net working capital. And so we've gone ahead and used the basic free cash flow equation. Well, what does that result in? So I want to have a project return on invested capital. Well, remember, my invested capital is 50.45. My NOPAT, which is what I'm using here for this instead of NOPLAT, is a negative value. So I have negative project return on invested capital. That's not happy. In fact, it's negative to a pretty big way. I've even got economic profit that's negative. Well, how do we get that? Well, net economic profit is invested capital minus ROIC times WACC. Well, what do we have here? So here I've got invested capital P20. In AC20, I've got ROIC, that was 7.06. And in D10, I've got WACC. Let's go take a look at D10. And it doesn't look like WACC to me. It looks like the interest rate that I'm paying for the loan. I've got WACC and up here at 16%. I got ROIC at 25, almost 26%. But these numbers are for the whole operation, the whole company. We're bringing on a new asset to the tune of $5 million. We're borrowing 37.5. So it's 375 or $3,750,000. We are spending $5 million on a project. We're financing 75% of it. That leaves us with 37.5 debt. Well, 37.5 hundreds of thousands is $3,750,000. And that's where we're going to get our interest expense for the first period of time. Our interest expense is our cost of capital. We're borrowing money to do this. Well, you might say, wait a minute. So yeah, we're borrowing money to do it, but that only accounts for 75% of the capital we're expending. 75% of the capital is coming to us from debt. That means the other 25 is coming to us from equity. And if it's coming to us from equity and we're not raising new money, where's it coming from? Well, it's coming from drawing down our cash resources. So remember that that's going to be on a $5 million project. It's going to be 1.25 million. Do we have that kind of money? Let's go look at the financial statement. Yeah, we've got more than enough. We've got $10,930,000. Now I'm mixing my scales a little bit. Here I've got the balance sheet, income statement and such in millions. Here I've got the operating asset purchase in thousands. This isn't necessarily typical, but it's also not uncommon. And we could have done this in millions, but I wanted to give you an example of where you may not always see the exact same scale as you go from one sheet to another or one statement to another. And you really want to be paying attention. And as I said, this should have been hundreds of thousands. So I'm going to go do this. Okay, so now I've got a little bit of an understanding of what's going on here. I still want to examine this project economic profit, which I now recognize is my invested capital, which is the money we put into the event space, both our money and the banks, plus the net working capital we had to have committed to do that. And so that's our invested capital, which is nothing but fixed asset plus net working capital for this project. So we're using the ops approach, and we're going to multiply that by the project ROIC, which we just found at 7.06 negative, so that's ugly, minus the cost of capital for the project, which is our borrowing, and it comes up with a negative economic profit, which doesn't surprise us at all. I mean, in this first period, we're just in trouble. In fact, we might remain in trouble as we go through this for a while, but let's look at this. Let's challenge again why I use 6% for the entirety of the cost of capital. We might agree that 6% is the debt cost of capital, but what are the cost of capital of my cash? What is the opportunity cost of cash? Very, very challenging to calculate. So I think we've got to consider that the opportunity cost of cash is either the cost that we might bear if we went out and used some of our cash well, where is our cash invested right now? Money market funds at 0 dot nothing percent. Maybe it's in some cash equivalents, 30-day, 60-day, 90-day treasury instruments or certificates of deposit, still barely a fraction of a percentage. So those are very, very low. And it might be nice to use a low cost of capital, but the convention in the analysis space, if you will, is rather than use the actual opportunity cost of that money in terms of how it's currently invested, which is getting virtually nothing for us, or using the opportunity cost of that money in terms of what opportunities are we passing up because we don't have cash to spend on them, which is kind of unknowable. We know that if this company needed extra cash, it has the ability to go borrow it. How much is it borrowing it at? In this case, 6%. So we can justify that 6% figure for both sides of this cost of capital such that it becomes our cost of capital. And in this case, it's a very ugly economic profit for the project. So we're going to have to come back to that in a few minutes and see what we think about that. Let's go to the next period. The next period, I'm going to start with my revenue. So I had the prior period's revenue of 3, and I'm advancing it at the 40% growth. Let's back up to debt. And let's move forward with revenue erosion. I'll come back to debt in a moment. My revenue erosion. So I've got 1% of my revenue from the second year of Marriage Ravana over in the valuation without adjustments. My total project revenue, I'm still negative. So that's not good. My erosion is costing me a lot. So the distraction of those managers is costing me a grundle. It's not really costing me 4.696 in cash flow because I have some expense erosion as well. In fact, if I had revenues of 4.696 that I didn't get to enjoy, but I also didn't have to bear 3.753 in expenses, then I can calculate 4.696 of revenue minus the expense I didn't have to bear either, 3.753. So I actually lost EBIT of 0.943 when I combine those two numbers. That's still not trivial because 0.943 in hundreds of thousands is $94,300 of cash flow. That's not trivial, especially given this grossly negative free cash flow that we just experienced. So we're hurting here. The good news is we only have that revenue erosion for the first 2 years, and we only have the expense erosion similarly for the next first 2 years. So we came up with a 0.496, so 0.496 of total project revenue, so a little less than negative $57,000. A little less than negative $50,000. We've got some project Opex without DNA. So where is that? Well, we know that we've got 65% of the project revenue is project Opex without DNA. And now we've got some depreciation expense. And again, I've used the same metric here to come up with that depreciation expense. I'm doing it this one way. I don't know that I'm satisfied with that, by the way. So we may have to come back up here and look at this fixed asset purchase schedule, fixed asset depreciation schedule, and see what it might do for us. And maybe it'll let us fine tune that a little bit. But we'll look at that and come back to it. We got our expense erosion for the period. We know where we got that. By the way, we're taking the depreciable fixed assets at a 15-year useful life and straight line depreciation, of course. It results in an EBIT that's still negative. It's not as negative 3.563, but negative 1.83 is still nothing to laugh at. We now have our interest expense, and this is interesting. We have interest expense based upon the prior year's debt and then multiplied at the interest rate. Well, the prior year's debt, how does that differ from before? Before we took the initial debt, which hadn't had any pay down yet, times the interest rate. Now the prior year debt is the original debt. So D9, so the original debt, now subtracting the debt reduction of 0.25. So we're down to 37.25 in debt, or 3,725,000. We were at 3,750,000. Well, why are we doing this one period offset here? We're going to look at this. So the interest expense is taking the prior period's debt, multiplying it by the interest rate. The prior period's debt is the one we had in place all year, and that's what we get charged interest on. Remember, interest is charged in arrears. So this then culminates in taxable income that's negative, so zero tax, negative net income again. Invested capital, where is this coming from? Well, it's coming from the project gross fixed assets. And then we're having to think about that also the net working capital that we have for the project. We know where those are coming from. They're coming from the revenue commitments and the original balances. And we then are able to move beyond that to think about our project free cash flow the exact same way we've done before. Now, it's not negative this time. That's great news. But why is it not negative? Well, maybe a better question is, why is the first one so grossly negative? Well, it's so grossly negative because we picked up a significant amount of assets in this process. We had a tremendous growth of assets in this process. So that's hurting us. In the second period of time, we don't have that much growth of assets. So that's helping us rather a lot. And each year, we're doing the exact same thing. The only year in which this is going to look any different is in the third year. We no longer have the revenue erosion or the expense erosion, but otherwise it looks exactly the same. And in the final year of our forecast, which would be the first year of our continuation, we now are growing the revenue not at 40, 30, 25, or 20%, or we're growing it at 2.5%, which shouldn't surprise us because we've got that in our assumptions table. Now, this is one of the first times that we've created an assumptions table that's given us fidelity year after year after year. We haven't just made an assumption as to the revenue growth for the entirety of the explicit period and then normalize that down to some very nominal growth after the explicit period. You've known all along that we could do this. We just haven't applied it. So in order to do it, we've got to have a revenue table, and we maybe even going to expand that into other tables. We'll look at this with more detail as we go into Finance 495 in the Capstone project, where we do a different kind of assumptions table and forecasting than we've done in Finance 309. Well, that results in all of my free cash flows. So now how am I going to use them? Well, in green, I have the free cash flow model, and I'm going ahead and picking up just the free cash flows from the explicit and first year of the continuation period. I'm not picking up a cash flow in time zero. Why am I not doing that? Because here I'm trying to find the value of the project, not the net present value resulting from the project. And so I've gone ahead and I've taken each of the cash flows, as you might expect. I've then discounted them for rate and time. And then I'm using the discount rate of 6%. And time is picked up by this A30. Well, A30 is over here. Was it picking up? I've got my periods again. I don't know why I have it here twice, by the way, but I do. Not sure I would do that again the same way. I should have perhaps just picked it up from right here. But it's giving me the periods. It's giving me the discounting. And I do this exactly as you would expect using these project cash flows. But then I have this project free cash flow in the first year of the continuation period. And I'm going to use that in my continuing value. Notice here that in my valuation structure, I'm simply picking up my summation. And then here I'm about to use the cash flow that's spun off in the first year of the continuation divided by a discount rate minus growth rate. Well, what are those? The discount rate is 6%. Growth rate is 2.5%. So I'm using your basic Gordon growth model, coming up with a continuing value. And then now I'm finding the present value of the continuing value, and those two present values together is my present value, or the value of the project, or the enterprise value for the company represented in this project, not for the whole company. Well, now I want to be able to run a net present value. And remember, to do that, I have to have all of my cash flows starting at time zero lined up, because you remember that the calculator doesn't like time zero all that much, but it gives us a cash flow register to accommodate for it. Excel doesn't like time zero at all, starts everything at time one. So what am I doing here? So I'm simply taking the amount that is being spent on the project. That is the $5 million. This is not expressly a return on my investment. This is a net present value of the project. And we might be able to argue that maybe all I should have had here, instead of the $5 million, was the $1.25 million, $1.25 million of the company's money that we invested. We'll come back and see what that does in just a moment. But when we think about the project as a whole, we're spending $5 million on it. This is a little different than our return on investment for the project. So this gets a little convoluted, but you have to think about it both ways, I believe. So $5 million invested, negative free cash flow, positive, 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 just exactly as we have right over here. But in this period where we've got a project free cash flow of 3.14, we now need to add to it the continuing value, because remember, that continuing value is a present value at time zero, where we used the cash flow from time one. And if we used year 6 as time one, that means year 5, the year before one, is 0. And so now we're going to take and add up both the cash flow coming from the project for that period, plus the present value of all future cash flows, which we call the continuing value, but it's present at that moment in time. And now we can run the NPV equation, NPV structure. We can do it a couple of different ways. I initially have run it simply by looking at the present value of the benefits and subtracting from it the present value of the cost. Let's see if we can get the same number or something close to it by using a different way of looking at this. What if we said equals NPV, and now we pick up all of these. Oh, we need to pick up the rate first. Let me equal NPV. We're going to pick up the rate, which is our discount rate. Well, we've got to divide that by the period as well. In this case, it's 1 year period, so we don't have to worry about that. Now, comma, we're going to pick up the cash flow starting at time one, and then we're going to parenthesis, and then we're going to add the cash flow at time zero, and we're adding a negative value such that we get a number that is very recognizable. In fact, we get the exact same number. So using net present value as the present value of the expected future cash flows, or present value of the benefits, minus the present value of the cost, resulted in the exact same number as using the net present value function in Excel. Remembering the idiosyncrasies it has, requiring us to line up all of our cash flows, embed in this final cash flow of our finite series of cash flows the present value of all future cash flows, including this one and all of this. And then we recognize that Excel doesn't like time zero, so we add back in our cost. I've got the cost as a negative. If the cost was showing up somewhere here as a positive, like it does up here in cell D13, I would have subtracted it, but I've already made that subtraction here as I've lined all of this up. So either way, I've got the exact same net present value. Well, now I've got that net present value. It's positive. That means I know that the internal rate of return is greater than my discount rate. Now let's think about what that's really saying to me. My discount rate was 6%, a 25.75 net present value against a 50 investment. So that's more than half of the investments number spread out over 5 years is not a trivial increase in the rate of return. In fact, I would have expected that to have given us an additional 8 or 9%. In fact, that's exactly what it did, because we've got a 15.15% IRR, so 9% greater than the 6% R, gives me a profit index of 1.51. Well, what was the profit index? It is the present value of the benefit divided by the present value of the entire investment, or the cost. What's the payback period? Well, the payback period is a long old time in this case. In fact, let's look and see what I've done. I've got column C30 to C35. And how am I doing this? Well, I'm taking D13, which is what it cost me. I'm taking the average of these years of cash flows and dividing the cost by the average of the years of cash flows. So I'm approximating this. I'm not doing this very rigorously. And that may not be a great way to do it, but it's kind of a quick and dirty way to do it. So I'm approximating this. And so I'm taking it and saying the average cash flow, so the amount divided by the average cash flow, and it tells me it's going to take almost 32 years for this thing to pay itself back. I may not love that. I might have to think about whether this is a good investment. But you know, I've got a pretty good internal rate of return. Now, in most real estate projects, we wouldn't expect to hold them for this long, but this is part of the company's long-term business strategy. This isn't simply an investment in real estate. So we might have to think about that a little bit differently. And then my discounted payback, I'm doing the same thing. I'm taking that 50 investment, dividing it by the average of these years, and calling that the discounted payback period. It's more than 55 years. Well, I've given you a little bit of a description here, saying it might be unacceptable to some. Well, I hope that this gives you a little bit better insight into how I put this together. I'm going to guess that some of you replicated some of these numbers perfectly. In fact, my guess is all of you replicated some of these numbers perfectly. I'm going to guess that some of you replicated most of these numbers and functions and equations perfectly. I'm going to guess that few of you were able to replicate all of them. But in having to grind through, you probably learned a few things. Seeing this may have made that a lot easier for you had you had it in advance. Seeing it now might help a little bit. And I apologize for not having had the time to be able to create this for you prior to working on it. I know some of you were asking questions of me when you were going through this, and I answered a lot of these questions. So now let's go ahead and take a look at what's going on over here in these schedules. So my asset purchase schedule, where is this coming from? Well, in year 0, I'm saying somewhere at that end of that, I bought this fixed asset. Well, where did I get this? Well, it's a depreciable asset. Remember, we had an asset at 50 that is depreciable. Only part of it is a building, part of it is raw land. We can't depreciate raw land. So I've got depreciable fixed asset coming off of this number, and I'm saying it's 35. I'm going to depreciate that, but this is the purchase of that part of the 50 or $5 million asset. After the first year, I have to depreciate it a little bit. So let's move over to the other schedule real briefly. So how do I get this next number? Well, I have to put in the depreciation amount. What's the depreciation amount? For this asset that we acquired in time period 0, which has a 15-year useful life at straight line depreciation, I've got a 2.33 depreciation amount every year for the entirety of the schedule. Okay, so every year I take the prior period's depreciated asset minus the new depreciation. I do it every time. That's the effective straight line. So in the next year, year one, by the end of year one, I have gone ahead and made a commitment of 5% net capital spending. So I'm spending 5% of my revenue on new fixed assets. That's going to equate to net capital spending for the project. Remember that equated to 5% of the revenue. So I've got an asset acquisition in that first period of 0.15. That depreciates down to 0.13 in the second period. How did it do it? Well, I took the asset that we acquired. I now believed I had a different depreciation schedule than I had for my building, because these are maybe additions, improvements, furniture, equipment, and such to flesh out the building. So I'm taking 7 years as a straight line. And so every year I have depreciated by that year's depreciation. I put this all together in this way so that I could sum up my depreciable assets or depreciated assets at any moment in time. And so I could think about what my total depreciation might be. Let's look at the depreciation I used in that first year, 2.343. Well, where did I say that I got that? So I took this asset of 35.15 depreciated over a 15-year cycle. Remember me questioning a few minutes ago if that was exactly the right way to do it. I'm not sure that it was, but it is what I did here. Might be an approximation, is not quite good enough. Maybe I should bring some of this into the equation now. Where did I get the 35.15? What was the original asset that was depreciable, plus the additional assets that I picked up that are also depreciable. But they're depreciable on two different schedules, and I'm kind of using the same schedule to depreciate them. So that may not be the right way of doing that. I don't know if you had picked that up, but we may have to work on that. Let's go a little bit further then and see what else we've got going on here. So we had 2.343 versus 2.35 if we add that up. So that's a little bit of a difference. 2.35, the sum of 2.33 plus 0.02, that would be the depreciation that I calculated for that year. Maybe I would have been more accurate to have brought that number over here. And instead of 2.343, that's a very trivial difference, but it is a difference nonetheless. So I would have to argue that we lost a little bit of quantitative fidelity. So I think if I were to do that again, I would do it a little bit differently. And I create this asset depreciation schedule each time. I could sum up the depreciation amounts. I could sum up, if I wanted to, the depreciated assets, and that might help inform a little bit of this a little bit differently. Interestingly enough to me, I left this incongruity in here, hoping that someone would ask me about it. Nobody asked me about it. Now, I know some of you, I think all of you, most of you at this point, have completed this assignment. No one asked me about the incongruity. And that either means that you didn't understand the schedules, which we'd never gone over them before, but I was hoping some of you would just be able to, through critical thinking, logically think them through. And a number of you did, but didn't see the incongruity between the summing of the depreciations and the depreciation I actually used for any given period. Well, again, I hope this helped. I know it's exciting stuff to watch on a Tuesday night or Friday night maybe, but it is what it is. Hope you guys have a good evening, and I'll talk to you later.